Oh, there we are. All right. Welcome, everyone. 7 o'clock, and we're going to get started shortly here. I'd love to see where everybody is tuning in from. If you want to put in the chat where you guys are connecting in, I'd love to see where everybody's joining in. Now, we can't see you, just a little housekeeping here. We can't see you, but we can see your chat. Awesome. Sarasota. We are here in Sarasota as well. Toronto, welcome. Raleigh, North Carolina. Nothing like the good Carolinas. My family's up in the Hickory, Asheville, Charlotte area. Michigan.
Michigan. It's a good one. That's where I'm from. Great state of Michigan.
All right. Well, just again, we can't see anybody. If you have any questions during the presentation, feel free to put that in the chat. Georgia, welcome. We're going to do our best to try to answer them, but your questions will be answered at the end.
Ooh.
Oh,
look at that.
Nice.
We just had a team out in Honolulu just last week.
I know. I think they're all just getting back. I look forward to hearing their experience. Okay, great. We're going to get started. Everybody, make sure you're in a quiet place. You're taking this time to dedicate and invest in yourself. Just have your full attention, and I promise you, you will not be sorry. So just a little bit about us. We are BQuest Asset Management Firm. We're a small boutique asset management firm here in Sarasota. We are a registered investment advisor, and we've been serving our community for over 5 years. And we focus simply on consistent, predictable monthly passive income. We have never missed a payment to our investors, and we take pride in that. And our purpose is to help everyday investors earn steady, high returns so they can confidently build financial freedom. My name is Rebecca Samples, and I'm a cash flow strategist, and I'm part of the BQuest Investor Relations team. And I've got my colleague here, Sean Munyo, and also one of the managing partners. Sean, you want to introduce yourself?
Yes, thank you, Rebecca. My name is Sean Munyo. I'm one of the co-founders and managing partners here at BQuest. As Rebecca mentioned, we specialize in generating passive income through alternative investments like mortgage notes, real estate, and energy infrastructure. Just a little bit about me. Before launching BQuest with the founder, Martin Sines, one of the founders, I spent over 15 years leading technology investment strategies for Fortune 100 companies. And I'm excited to be here today with you to share some insights as to how we can help you grow and protect your wealth.
Yes, thank you, Sean. I'm here, so I want to give everybody just a little disclaimer. I'm originally from New Jersey, so I tend to get really excited and talk fast about this topic. So I'm going to do my very best to pronunciate my words and speak slowly. So give me some grace on that. You see our picture down here. This is my husband. We don't have any kids. We got 2 fur kids. We've got a 2-pound Chihuahua and a 130-pound Great Dane. So I've got to work on getting a decent family picture, but that is me and my husband down here. So I want to start off and ask every one of you a question. How many of you guys have checked your 401k balance this morning, if you have one, or sometime in the recent last few weeks, and had a little knot in your stomach when you looked at it? Raise your hand, or put a little comment if you had checked your 401k balance. So you might have had some sort of like uncertainty, questions. Well, that's what we're going to talk about today, is how you can invest without any of that anxiety. So let me see here. Kayla, you want to help me with here we go. Thank you. So what if you could invest without any anxiety or stress? Imagine knowing exactly what your returns will be and not guessing. Imagine not having to check your portfolio every time the market takes a dip or makes the headlines. What if your money was working for you predictably without needing to follow the news or worry about the recession or the inflation? And this is what we're here to talk about today. I know there's a lot of stuff going on in the news now with Iran and the tariffs, and that affects your investments. I want to share I had a client a couple years back. She was getting ready to retire. She was a school teacher. And during the year she retired, she'd lost half her retirement. So now she's in her 70s and she's looking to pick up a part-time job because she's concerned that she's not going to have enough money through the rest of her years. So raise your hand if you ever felt uncertain about your investments. All right. Well, there's really two paths you can take when it comes to investing, and they lead to very different outcomes. So let's talk about the first path. It's your traditional mindset. And this is what most of us were taught, buy and hold, hope the market goes up. It's filling up a savings jar and crossing your fingers and hoping it grows. But that hope comes with lots of stress and anxiety. But, what are you saving for? We were told to build this giant nest egg, right? And hope it lasts during retirement. But just like an example I gave you earlier, what happens if you don't have the money during that? Did you know that 64% of Americans are more afraid of running out of money during their retirement years than dying? I really want you to think about that. I mean, people are afraid of running out of money than dying. And the problem is you don't know how long you're going to live. You don't know how much healthcare is going to cost or what inflation will do to your savings. So every time you withdraw, it feels uncertain, like you're chipping away at a pile and hope it doesn't run out. Let's look at the second path. And this is what here and us at BQuest like to hang out on this path, is the cash flow mindset. Instead of hoping for growth, you build income. Your money sends you paychecks every month, just like a rental property, without the headaches. It's about building a retirement paycheck and not a retirement nest egg. So what are some ideas on cash flow investing? Here's a few of them that you probably heard of, and why they fall short when it comes to true reliable cash flow. So the first one, let's talk about stocks and EFTs, right? They're pretty popular, but they're incredibly volatile. Your returns are tied to the market swings, news and headlines, and again, global uncertainties, and there's no guaranteed consistent income. And in the down market, you're left waiting and hoping. What about REITs? Does anybody know what REITs are or invest in REITs? Okay, well, REITs are real estate investment trusts that trade on the public exchange. And while they can offer dividends, they're still highly correlated with the stock market performance. That means they're just as vulnerable as a downturn. And because they're publicly traded, they often come with management fees and lack of transparency into their underlying assets. So they're not true direct ownership. That means there's less control and less predictability. What about bonds? They're considered safe, right? But right now, many bond yields are well below inflation. So while your money might feel safe and protected, it's actually losing value in real terms. Here's another one, annuities. Now I want to put a disclaimer, annuities are not investments, but people look at this as a form of cash flow. And they promise, lifetime income, but sometimes they come with high fees, long lockup periods, limited flexibility. So you have to ask yourself, are you trading liquidity for security? Sometimes it's not always a fair trade. What about crypto and technology? I mean, they've created millionaires, right? But they've also wiped out fortunes. So most people are still tracing these gains and living with anxiety. It doesn't have to be that way. There is a better path, and it's rooted in real assets. And that's what we're here to talk to you about. Real assets that generate consistent cash flow every single month. So let's talk about private asset opportunities. We focus on private assets where there's no stock market exposures, no complex strategies, just real assets that produce real income. That means monthly payouts, real collateral, accessible for both accredited and non-accredited investors. We want to make sure we don't leave anybody out. This is the foundation that guides this approach is what we call here at BQuest is our 4 C's. So I'm going to take a side note here. We've got a poll coming up. Feel free to answer that while I'm going along. We just want you to be a little bit more interactive since we can't see you. So the 4 C's here at BQuest is these 4 pillars we have with one goal in mind is to help everyday investors feel confident and in control of their financial future. And the first one is cash flow. This is the heartbeat of everything that we do here at BQuest. Our investments are designed to send you monthly income, not just growth on a paper, but actual money hitting your account every month. And control is our second one. We have ownership of the direct hard assets. We don't hand your money off to a third party. We manage our assets ourselves, and we make decisions in-house. That way you know exactly who's behind your investments and how it's being run. And the third one is community. We're not just about numbers. We're about people. We partner with investors who value transparency, integrity, and legacy. When you work with us, you become part of something bigger. We focus on investing in real estate and energy products that make a positive impact on the world. And the last one, comprehensible. So I love what Warren Buffett says. He says investments must be rational. If you can't understand it, don't do it. So we believe good investments should make sense, clear and not complicated. If you understand how a home mortgage works or how energy keeps the lights on, then you understand what we do. You know, this is what makes BQuest different, and it's how we help people move from confusion to confidence. All right, let's see here. 14. Okay, we have got 43% here in our poll that says yes, monthly payouts with real collateral. Well, you guys are in the right place. I want to move on to, I'm going to bring Sean in here, and he's going to talk about the power of real estate and energy and how it generates returns from 2 powerful asset classes. And that's our mortgage notes and our energy infrastructure. These are real world income producing assets. So Sean, you want to break this down for us and what this looks like?
Yes. Thank you, Rebecca. And appreciate you all joining us this evening. Rebecca, you did a great job setting up the real challenge out in the marketplace for folks who are really looking for income producing assets. I kind of tell a lot of my friends all the time who maybe are more focused on alpha than on generating income. I tell them, listen, you're out in the marketplace looking for great places, great companies to put your wealth, right? And you think about a great company like Apple, and everybody likes to buy the Apple stock, but what everybody loves about Apple is they generate a massive amount of cash flow. In fact, I heard it's $100 billion every 30 days is what they're creating from a cash flow perspective. But yet, in some of our own portfolios, we don't have any assets that actually produce cash flow. Like we invest in companies that have massive amounts of cash flow, but we don't actually have anything in our portfolio that generates cash flow. And Rebecca talked about the challenges in the marketplace about finding, true, consistent, predictable returns from the market. But what I want to talk about tonight is really the power of two things that everybody really understands. It's the power of real estate and energy. And I'm going to talk a little bit about how we invest here at BQuest. It's likely something you've never heard of before, right? It's something that is unique. It's clearly unique to us. There's not many folks in the marketplace who are doing what we do with energy and real estate. And so I want to be very clear. I want to focus on exactly what we do and how we're different than everybody else. These two asset classes, real estate and energy, are likely the largest two marketplaces in the world. I think it's been said that the real estate market worldwide is around $40 trillion. And I was just looking today at how large the energy market is around the world, and it is hundreds of trillions of dollars that's moving around the marketplace if you look at all the different asset classes. And I just read a stat just this morning about how the energy demands of the world will double in the next 20 years. And so energy is a hot topic right now. But let me get into how BQuest invests in real estate. And it's something that's very unique. We call it mortgage note investing. And so let me tell you a little story about how I got into mortgage note investing and when I actually saw the light. I didn't mention this, but I'm a third generation real estate investor. I did work in corporate America for technology companies developing investment strategies, but I was a real estate investor at heart. And in fact, I remember when I was a little kid, how I used to earn my allowance from my grandfather is I would go work at some of his rental properties. And so when I got my first job in corporate America, I went and took my paycheck and I went and bought my first duplex. And so I kept buying real estate because that's what a third generation real estate investor does. They follow their family and what we do. And so I started buying real estate. I started renting it out. And I'll never forget, I would remember that the roof would leak, the pipes would break, tenants would move out. And sometimes I actually got a mortgage on some of these properties, and the bank always seemed to get paid, right? Even though I didn't some months, I didn't get paid, but the bank always seemed to get paid. And what I realized is the bank, they actually never got the phone call that I got that in Florida, is where a lot of my rental properties were, the air conditioning in July broke. They never got that phone call. And so I always thought to myself, wow, wouldn't it be great to be the bank? To never have to worry about whether you're going to get paid, whatever's going on the property. And in fact, if you didn't get paid, you can come in and swoop and take that property back. I always thought, wow, it'd be really amazing not to own the property, but to own the paper on the property. And in 2017, when I was looking for some investment strategies, I found a book on the internet called Note Investing Made Easier. And that book taught me about how to become the bank, right? I'll never forget, I was reading that book, and it had just come out on Amazon. And I downloaded it. I was on a flight. And by the time my flight landed, I had finished the book. At the end of the book was an author's email address. I'd never emailed an author in my life, and I had emailed him right away. I said, this is exactly what I'm looking for. I always wanted to be the bank. What your book talks about is How to Be the Bank. I'm interested. I need more information. This book isn't enough. What do you know? 5 minutes later, the author of that book actually emailed me back. And that changed the trajectory of my career. And what do you know? But I don't know, 8 years later from that point, the author of that book was Martin Sines. And he's actually my business partner here, founding partner here at Bequest. But what I realized was the power of owning real estate notes. And in fact, that's what we do here at Bequest. We go out and we buy mortgages that were originated from the banks. And so these mortgages are what we call re-performing mortgages. And so at one point in time, the borrower stopped paying on the terms of the original note. And it's always three things that a borrower stops paying for. It's health-related issues, it's loss of job, and it's a divorce. I'm sure you've all have fallen on hard times at one point in your life. And what we know is these are still good people. What their experience is something temporary. And so these borrowers get back on their feet, they find another job, they get healthy, they get remarried, and they start paying their mortgage again. But most of the times, banks will modify the terms of these loans. And because a loan has been modified from the original terms, it's been changed, it has a mark on it. And those are called re-performing mortgages. And so we buy those types of mortgages. These borrowers are paying their bills. They're paying their mortgages. But banks will sell these types of mortgages on the secondary market. It's not a market that a lot of people understand, but we're well entrenched in that market. We go and buy these loans at a discount from the banks. People always ask me, like, why in the world would a bank sell a re-performing mortgage? The borrower is paying. Well, there's good reason for that. And that is most of the regulators who are regulating the banks, they see these types of mortgages on their books, and they require the banks to over-collateralize those types of loans. And so instead of the bank having to hold extra cash reserves for these types of loans, they will sell these loans in the secondary market. And we are one of the largest buyers of re-performing mortgages in the secondary market. And that's why we buy these at a discount. We're able to generate a significant return for our investors by just holding these assets for cash flow. And it's a very unique type of investment. And in fact, we're actually experts when borrowers get behind again, right? We have a loss mitigation shop here inside of Bequest, and that all that, it's just a fancy word for meaning we know how to repair mortgages if they break. We have a team of people who do that, who work with the homeowner, keep them in the home, maybe modify the terms for them just to keep them in. But that's what we specialize in, generating cash flow from mortgage note investing, specifically buying what we call re-performing mortgages off the secondary market. We're one of the largest buyers in the marketplace. Here's an example of notes that originated, again, by large banks, PNC, Wells Fargo, Bank of America. These are the types of loans that we buy. We become the bank, even though we're a fund. We become the bank, and the mortgage payments come to us every month. And those distributions go out to our investors. If in fact the borrower gets behind, that loan goes off to the repair shop to work with the homeowner and try and keep them in the home, generating income for our investors. And I'm happy to answer more questions about that side of our portfolio. It's a very interesting market. And so just drop some questions in the chat right now if you can think about them, and I will answer more of those questions at the end. But I've always been asked, like, what's the difference between investing in mortgage notes and investing in Wall Street? And so there's a lot that's very different. But I think one of my friends is actually on this webinar. His name is Jan Naismith. And Jan is on this webinar with me, and he's a mathematician. He's been in the investing industry now for well over 30, 40 years. He's the godfather of investing. And I came to Jan. He's a really smart guy. In fact, his great-great-grandfather, I think I got that right, invented the game of basketball. I said, Jan, why don't you look at our fund and tell me what the beta of our fund is to the S&P 500. What's the correlation between our fund and the S&P 500? And he came back to me and said, Sean, I've looked at a lot of funds over the years, and the beta on your fund is basically 0. But he said, I'll give you the real answer. It's 0.03, right? And so the beta on our fund is 0. What does that mean? It means that there's virtually 0 correlation between what we're doing and the S&P 500. And so if you're looking for ways to separate your risk from the stock market, you need to go to the alternative space, and you need to find a fund like Bequest that invests in an asset class that has virtually 0 correlation to the market. That's the big difference between Wall Street and mortgage notes. Another great, interesting difference is the collateral aspect of it, right? When we buy a mortgage note versus a stock certificate, behind that mortgage note is actually some real collateral. It's real property. And in fact, if the borrower stops paying, we'll work with them. But if we can't come to terms, we get to go take the property, real hard assets behind that, instead of a stock certificate that may have something behind that, but you're not actually sure what it is. But these are the big differences between Wall Street and mortgage notes. And it's one of the big reasons why investors, well over 200 investors now, call Bequest their home. Rebecca, any questions? I saw a little pause there.
No, it was great. I'm processing everything. So just summing it up, we're basically the bank.
We are the bank. We are absolutely the bank. And the mortgage statements that go out, we obviously, we have a licensed servicer who does that for us. But yes, when the mortgage statements go out, that's done through a servicer. They collect the payments for us. They're licensed to do so. They send the remits to us on a monthly basis, sometimes on a daily basis, and we actually send those out to our investors. So that's how we generate cash flow from reperforming mortgages. The second,
Wonderful.
Yep, thank you, Rebecca. The second interesting asset that we have that we focus on is on the energy side. And so I told you a little bit about my background. I was in the technology industry, developing investment strategies for Fortune 100 companies. I was there when we were building very large data centers for Google, Microsoft, Facebook back in the day. And so we would scour the earth for the best location to build these data centers because we were putting hundreds and hundreds of millions of dollars inside these facilities. And when we were looking for places to put our most strategic assets, we were always concerned about some different things. And we were concerned about location, right? Is it in an earthquake zone? Is it in a hurricane zone? Like, what type of natural disasters could actually hit this asset? What were the ways that the data came into the data center? Were there redundancies? These are all the things that we were focused on. Never once did we ever focus on, in my 20 years of experience, never once did we ever focus on the cost of energy. But today, it's very different. I mentioned to you that over the next 20 years, the world's energy demands are going to double. I don't know if you've heard recently, but now with the invention of AI and blockchain, the energy demands are just off the scale. And so these big operators are focused on one thing, and that's the cost of energy. And recently, if you've maybe heard some news articles that Facebook, Amazon, they're trying to build nuclear reactors next to their data centers in order to continue to find cheap electricity, because it is a very strategic asset for the next generation, for the future. So here at BQuest, we've actually found ways to invest in energy that is likely unique than anybody else. And in fact, we are investing in the infrastructure that supports both AI and blockchain workloads. And in fact, we built an energy park down in southern Texas, down in Raymondville. And this energy park was designed to allow tenants, right, this real estate and energy, to come onto the property and buy electricity from us. We actually buy it from the grid. We have a piece of land next to a very large substation, and we have about 10 megawatts worth of capacity. And we built out the infrastructure next to this power plant, and we have a lock on that power. We have a purchase power agreement that allows us to hold that power from the power company. We build out the infrastructure. We build out transformers and locations for tenants to put their computers, both AI and blockchain machines. And we sell electricity to those tenants. On average, we pay about 4.5 cents per kilowatt hour. And we're selling that power to tenants that have a high demand, 24 hours a day, 7 days a week, 365 days a year. Those tenants consume that power, and they pay about 7 to 8 cents per kilowatt. And so we're making power arbitrage on this energy site. And that's how we generate cash flow for our investors. And so this talks about how we're generating cash flow, how we're generating income from infrastructure. We're locking the power up for very long terms. We are building out the infrastructure. We're having tenants come on the property just to bring their machines, and we're selling that power to them. They pay their power bill every month. We then distribute that cash flow out to our investors. That is how we, in a very unique way, invest in what we call modern energy here at BQuest. And so the stable returns from energy are very different than the S&P 500, right? Again, Wall Street, there's a lot of speculation that's going on. Things are changing daily. On the energy side, we have long-term contracts with tenants who have a demand every day to consume this electricity and to pay that power bill every 30 days. It's very different than these are essential services versus what goes on in the marketplace, how things are priced. There's a lot of emotion in Wall Street. And so these are the differences between energy investments, modern energy investment with BQuest, and what's going on in Wall Street with stocks, maybe energy stocks that are traded there. Very different types of investments. And so these two powerful asset classes have come together here under the roof of BQuest, and we are using the power of both real estate and energy to generate consistent, predictable returns to our investors. As I mentioned, on the real estate side, borrowers make their monthly payments. It's secured by real hard assets, real estate. These are single family properties. And about 35 states is where we operate. And most importantly, they're owner occupied. That's key. That's key to the investment strategy. We want people who live in the home to pay the mortgage. And it's all focused on the residential marketplace in suburban America, all across 35 states. On the energy infrastructure side, we're focused on generating monthly energy revenue by tenants that are inside these parks. Again, it's secured by real estate and hard assets. And this is where the industry is going, right? There's a focus on energy. We found a way to lock that power up. These two asset classes are very powerful. And Rebecca, I'll let you take us through the next pieces of this.
Sure. Sean, before we move into the team, I just wanted to sit on this for a minute.
Yeah.
I know we've unpacked a lot of information in a short period of time, but just to kind of sum this up, these are both real assets secured by real properties. And what we see and what we've been hearing is this both are monthly payments to our investors. And one is residential focused and one is industrial focused. Now, I know people probably have questions about it, probably hasn't come yet, but let's just talk about risk. It's investment. We're saying it's low risk. Can you elaborate a little bit more about how these assets are low risk?
Yeah, I mean, listen, low is a relative term, right, to the marketplace. These are still investments, but we think about what can go wrong and what can go right. And what we like to focus on here is a term that is well used in the marketplace called asymmetrical returns, right? And so if you look up what asymmetrical returns means in an investment class, it means your downside risk is limited, but your upside potential is much greater. So your upside potential is much greater than your downside risk. And so here's a perfect example as to how we put that into real world terms. If you think about the mortgage side, just for one moment, we have a borrower that's in a home that's making their mortgage payment. And on average, we have what's called an investment to value ratio across the portfolio, that we don't have more than 65% of the asset value into the mortgage that we buy. Let me give you an example. There was a lot there. So let's say that this property on the left here was worth around $200,000, just for simple numbers. Whatever the balance of the mortgage was, we would never have more than $130,000 into that mortgage. It doesn't matter what the balance of the mortgage is. We would never pay more than $130,000. Well, why is that? Well, because we want to make sure that we have a 35% equity cushion above our position, right? I mentioned to you that we're buying these notes at a discount. We're not paying par for these loans. We want to make sure that we have a 35% equity cushion. Why do we want to make sure we have a 35% equity cushion? Because we know through experience that if the borrower stops paying and this property, which we'll try very hard to stop from going into foreclosure, if it goes into foreclosure, most of the time a property like that will sell at the sale. They don't really do them at courthouse steps anymore. Most of them are done online. There's still some that are still done at the courthouse steps. But those properties on average will sell for 80 cents on the dollar. So that property that went into foreclosure, this $200,000 property here, will likely sell at the foreclosure sale for $160,000. So I mentioned to you, we bought this mortgage. Likely the borrower was paying us for a little while. Something bad happened. They stopped paying. We couldn't get them to pay anymore. We had to take it through foreclosure. It goes to sale and sells for $160,000. I mentioned to you that we're in that property for around $130,000. So in a bad situation, we still have a capital gain for the fund. Those are some examples of how we protect our investors when things go wrong, things go sideways. We call that asymmetrical returns. And so that is how we protect our investors. I don't know if that answered. That was a long answer to your question, Rebecca. You got me a little fired up about that one.
Hey, we're in the same boat. We love it. We get excited. No, that was great. I think that just compliments on one of our 4 C's about the community. It sounds like, how you were sharing is we try to help these families stay in the homes. We try to work with them as best as possible to keep, you talk about it all the time, right? Emotional equity in the home. You always share about, they grew up in the house, the kids, had first babies, graduated from college. There's emotional equity in that home and they don't want to leave. So we do our best here at BQuest to work with clients to keep them from going into that foreclosure. So thank you. Thank you for sharing that.
Sure.
I'm going to talk about our team. I'm biased. Our team is probably the best. Everybody here, I remember, I'll share a little story when I met BQuest, maybe I think going on 2 years now. And I came to one of their alternative investment little meetups, and I walked in and I was like, I'm at home. I feel home. Everybody is so welcoming. The belief systems, our values, it all lined up. Because we are a boutique asset management firm, a lot of our employees, our managing partners like yourself, are accessible. If you've got questions and you want to know, we have the transparency. We take pride. We've got over 200 plus investors. Again, what I've mentioned before, we haven't missed a payment since we've been in business. So this is something that we stand on and we're very proud of here at BQuest. So I did see a question here in the chat here. So this is what we're going to address. So there are 2 funds. We have our income fund. That is our first fund. That is where all our mortgage notes are housed in that fund. And then we have the legacy fund, which is a hybrid between the mortgage notes and the modern energy assets in that. We have an option for accredited and non-accreditors. So I want everybody to make sure that you can take advantage of this Q2 promotion that we have going on. This is what's here in front of us. So basically, the more you invest, the higher yield you get. We have till the end of the month for you to take advantage of this. As you can see here, we've got that legacy fund down at the bottom for our non-accreditors. You come in at $50,000 at 9%. Sean, you want to add a little bit more about these funds and what makes them unique?
Yeah. Thank you, Rebecca. So on the right, as Rebecca mentioned, it's our oldest fund. It's been around for 5 years. It was our first fund that we launched, Martin and I. It is just performing mortgages. That's the only thing that's in the fund. And so if you're like, listen, I love the mortgage aspect of your business. I'm not really interested in the energy piece. You would be a candidate for our the income fund. It's a single strat fund, as they would say. But if you're like, listen, I really like the energy component. I really like the mortgage notes. There's also commercial real estate and legacy. That's actually the 3rd pillar. And so with those combination, it's a multi-strat fund. We're able to generate a little bit higher yield for our investors in that fund. And so, whatever your risk tolerance is and whatever asset class you prefer, if you are all in on energy and mortgage notes and commercial real estate, the legacy fund is for you. If you're like, listen, I just like those that emotional equity, those performing mortgages, then the income fund is for you. And if you're non-accredited, we have an option for you. We have an option for everybody. That is a class inside of the legacy fund. And so that's what you would go into.
Wonderful. Great. Thank you for that, Sean. So, again, this is our Q2 promotion, and it allows you to invest in either one, the real estate only or a blend of both the real estate and energy. And I don't know if we mentioned this before, but we keep talking about cash flow. Maybe some of you are not at that place where you need monthly income right now. You're still working. You've got cash coming in, but you're wanting to look for a place to build that legacy funds. Here Martin Science talks about the fruit tree. So you have an opportunity here where you can compound your investment. So Albert Einstein says, and I'm sure everybody's heard of it, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So who wants to earn it here? So this is an opportunity where you can take advantage of that compounding interest. And I just want to put this up here, probably going to put in the chat. You have an option to book a call and ask any questions you want. If this resonates with you, let's talk about your portfolio and how it can create monthly cash flow and give you a peace of mind with long-term impact. I mean, don't leave your future to chance. Let's sit down together and design something with intention. Before we go and we jump into questions, I just want to give you all a thank you gift for, let me just get out of here. A thank you gift for joining us tonight. This is over $385 value. We've got, you're gonna have click it in the link there. You can download it. You have the option to get this digital, or we'll actually mail you it. I've got my copy here. So this is my favorite book written by one of our partners, Martin Sines. We've mentioned him a couple times. I've got mine tabbed. I read it multiple times. We've got the Cash Flow Dojo. You got Note Investing Easy. You've got our Legacy Planner in there. If you kind of don't know what your why is, what about your investment thesis? Have you taken some time to write that down? And then maybe for some that you're like, well, I want cash flow, but I don't really know how much I need. We have an income statement there that you can start filling things out to figure out what your monthly cash flow is and what you're looking for. Sean, is there anything you want to add to that?
No, I talked about a book that was written by Martin Sines that I found on the internet. It's right there, Note Investing Made Easier. And so just click on the link before. We will actually send you this stuff. Just write in there, hey, mail this stuff to me. It's our gift to you for joining us today, just to listen about our investment strategy and how we're different from the marketplace. These are real gifts. We invest in creating education for our investors. We're about empowering folks with information, with knowledge, so that they can change the trajectory. I think at the beginning, Rebecca, you mentioned about people who maybe it was too late for them to build a cash flow strategy, but it's never too late to get started. And so right now, click on this resource here. We're going to send you some information. We will teach you how to build income in your investment portfolio. We'll show you the options that we have, and maybe we're not for you. And we know the investment community. We know a lot of folks. We'll get you to where you need to go. And so these are real gifts. We want to offer it to you. And so just go ahead and click the link there below, and we'll get you out the stuff.
Yes. Well, wonderful. I know we threw a lot of information out at you, and your mind is just blowing right now. It's like, gosh, what is this note investing? What is this energy? This sounds great. What's my next steps? We're here to help. Whether you're you're just starting out, or you're ready to diversify, like, I encourage you to take action and let's just have a conversation about it. So let's open it up to questions. I know there were some questions going on through the chat. Sean, do you see any that is interested? I see that we covered the different types of funds.
Yes. There was questions being asked in the chat. There was a question about, what is this? What type of paper are you buying? Are you buying subprime mortgages? And I would just say that we've all fallen on hard times before. I'm sure we've all been there. These are good people that have fallen on hard times, right? And so, no, we're not just buying really bad paper. We're buying paper that there was a 750 credit score on, but people get sick. People get divorced with low credit score and high credit score. It's It doesn't matter. Challenges show up for everybody. And so just because somebody went through a health-related issue, a loss or a job or a divorce, doesn't make them bad people. And so these are not subprime. These are actually just normal mortgages that the terms have been changed from the original terms, right, through a loan modification. And so it could be all types of mortgages. Somebody also asked, what kind of paper do you buy? Well, we buy first liens, we buy second liens, we also buy lines of credit. And so we have the expertise needed to buy loans that are all across the spectrum there, still collateralized by a residential home where the borrower lives, right? And so those are the types of assets that we buy. What does the property and note valuations? So I think I might have mentioned what we call our investment to value ratio. And that is around, that's a term, you hear the term LTV out in the marketplace. Most banks will lend on a property at an 80% loan to value ratio, right? That's what most banks, and if you got a mortgage today, they're going to lend most of the time. The best rates are going to be on 80% loan to value. We call it our investment to value ratio. Why? Because we're buying it at a discount. So it's about what is our investment into that loan. And again, our target across the entire portfolio is 65%. That's the goal. That's where we want to be. We're actually 62% across the entire portfolio, which means we have on average about 38% equity covering our position. We came up with that number because we saw what happened in the great housing crisis of 06, 7, and 8. And in fact, if banks had 35% equity at that time, most of them would have survived. And so we watched that, we experienced that, and we said, listen, if we're going to build a fund around mortgages, we're going to make sure that we can protect ourselves during the worst of the worst. And in fact, if we had a portfolio of these mortgages during the downturn, 6, 7, and 8, we would have been fine because of our equity that we have on the loans. So I don't see any other questions there, but all right. Noticing the returns offered from legacy are a bit higher than the income fund only. Yeah, so the energy component does generate a higher yield return than the mortgage notes. And so because of that, we are able to generate a higher return for our investors in the legacy fund. That's really the big difference. I don't see any more, Rebecca. Do you see?
We just got one more question here. How would you characterize the risk associated with the energy component? We talked about the mortgage, but what about the energy?
Yeah, so we're seeing massive demand for our energy. And so you think about it like, if a tenant that's in the property moves out, how quickly can we get a new tenant to come in? Well, there's massive demand for energy right now. You see it all over the news with AI and blockchain. And so the demand is really, really high. And we're locked up on very long contracts with a lot of our tenants. And so we measure our risk by how long are these agreements, who's in default to the contract. It's like very similar to maybe a commercial real estate property. You think about, occupancy rates and who's paying their bill. And so the properties are 100% occupied on the energy side, and we're generating consistent income from those assets. We see nothing but demand in the marketplace. Now that could change, but right now, from a horizon perspective, we see a great opportunity in this space.
Thank you. We have another question here. Great question, Mac. What is the lockup period for each?
Yeah. And so that's why we encourage you to kind of book a meeting with Rebecca and our team. They'll actually take you through. We've got different options depending on the amount of capital that you deploy with us. And so at a very minimum, we have some options for you to lock your capital up with us for a year at a minimum. We even, for a non-accredited, we can lock it up from a few months to like a couple years. On the accredited side, really the minimum is a year. The more capital you put with us, that can go up to almost 4-year lock. And so we've tailored it to allow you to pick what works best for you, right? And so we've got a bunch of different options. That's why we recommend you setting up an appointment with our team. They'll take you through all the options that may fit for your portfolio. You may need to have access to your capital sooner, or you may have some capital in an IRA fund that you're like, listen, I don't need this for another 10 years, so let me go put it into the fund and at the highest yield and lock it up for 3 or 4 years. You may be just fine with that. And you may say, well, if I put it in an IRA account, I don't need that cash flow. And we're like, yeah, you don't. And you can do what's called compounding, which increases the yield that you're going to get every year. And in fact, you're reinvesting your distribution that we provide to you. And so that's a good way to grow your IRA with a cash flowing investment. And you may say, well, I don't need the cash. I mentioned you can compound, but at any moment, if you wanted the distribution from your IRA account, you would call up bequest and say, listen, turn on that payment, and we would make a change in our side, and that payment would be sent out to your IRA account and allow you to have access to that cash flow when you need it the most. And so most of our investors, we can help you here. That's why we encourage you to set up an appointment. We can help you convert your IRA account into what's called a self-directed IRA account that would allow you to invest in alternative products like bequest and generate passive income with your retirement funds. So
yes, we work with many different self-directed IRA companies. So just to encourage you to get on a call, and we can dive into your personal strategy and see if that best fits your needs. I also wanted to add, tomorrow at 4:00, we're doing a happy hour. There's a link in the chat that you can click on and register. It's very informal. We're just going to get together and talk about different situations that are going on in the market, different things that people are investing in. It's more of just building a community where everybody can come in and share ideas and share some concerns that they're seeing. So there's no judgment. It's just fun. Come with your favorite drink, and just we're going to have a good time. Well, Sean, I guess that's it for this evening. Everyone, we really appreciate your time. Thank you for joining with us, and we look forward to connecting with each and every one of you in the next couple of days, in the next couple of weeks. Keep an eye out on our LinkedIn, our website, our social media. We are traveling quite a bit, and we host investor dinners when we go to each city. So we would love to have you join us. So thank you again for this evening, and we look forward to seeing you next time.
Thank you, Rebecca. Thank you, everyone.
Bye-bye.